This is the best way to pay yourself as a UK company director in 2024 so you can pay as little tax as possible. My name's Rehan Mobil. I'm a chartered accountant and the founder of Sidekick Accounting. I've helped hundreds of businesses make more money and pay less tax using strategies similar to what I'm going to show you in this video. Let's jump straight into it. As a UK company director, there's a couple of ways you can pay yourself. One is through salary, another is through dividends, and another is a mixture of the two. Understanding these options and choosing the right mix for your situation can save you a significant amount of tax. First, let's cover the basics. When I talk about salary, I'm talking about a fixed amount that comes out of your company through payroll every month, similar to any other employee. That amount is subject to national insurance and income tax. It's also an allowable expense within the company for corporation tax purposes. Second is, what do I mean by dividends? Dividends are distributions made to you as a shareholder of a company. They're made from post-tax profits and they are taxed at different rates to what you are on income. Dividend tax rates are typically lower than income tax rates. Each option has its own tax implications, which we'll cover in a bit more detail. The first thing to consider is whether or not to pay yourself a salary. I want to start with why you would not pay yourself a salary. If you have income from other sources, for example, another job or a rental property that already uses your basic rate band, you probably don't want to put yourself through payroll within your company because you're going to be paying income tax at 20%, which is higher than the equivalent dividend tax rate. Now, if you're not in that situation and you're working full-time in the business, you don't have any other sources of income, then the chances are the most efficient salary for you to take is going to be £12,570. And you might think that's a very specific amount, but here's why. This amount is equivalent to your personal tax-free allowance, meaning you'll pay no tax on this salary. It's fully tax deductible within your company, meaning you'll save up to 25% in corporation tax. However, it's also below the national insurance threshold, so you won't be due to make any national insurance contribution. Setting your salary at £12,570 maximizes your tax efficiency while still giving you some of those benefits of an employee. Once you've established if a salary is right for you, and secondly, how much that salary is, the next thing to consider is dividends. Dividends are taxed at a lower rate than income tax. That's why when you get above your £12,570 tax-free threshold, it's better to pay the dividend tax rather than income tax. The dividend tax rates for the current tax year that ends April 2025 are as follows. You pay 0% on your first £500 of dividends. This is called your dividend allowance. You then pay 8.75% on dividends within your basic rate band, so that's up to £50,270 of total income. You then pay 33.75% on your higher rate band and 39.35% on your additional rate band. All of these rates are lower than their equivalent income tax rates. Now, there is a nuance with the dividends that makes them a little less tax efficient than they look like on the face of it, and that's because they come out of post-tax company profits. That means within your company, you would have already paid up to 25% of corporation tax before that dividend is available to be paid to you. What most people don't realize is that even after paying corporation tax and dividend tax, you're better off than if you paid yourself a salary. The reason is because if you took a large salary, you'd be due to pay employers' national insurance at 13.8% and employees' national insurance at 8%. So to recap, the strategy here is to take a salary up to the tax-free personal allowance of £12,570 and to then take dividends ideally up to the top of your basic rate band of £50,270. This way you'll minimize your personal tax and also the national insurance implications. Now, the tax due if you structured stuff in this way is personal taxes of £3,200 on income of £50,270, which works out at an effective tax rate of 6.3%. The next question from most directors is, what do I do if I make more than £50,000? Well, if you need that cash to live, the next best option is to pay yourself dividends at the higher rate at 33.75% tax. However, if you don't need that money to live and you're using it for other purposes like investment, pensions are a great tax efficient option that mean you don't need to take dividends out and you can reduce your corporation tax liability. Other options that could minimize the amount of dividends you need to take out, therefore keeping you in the basic rate band, are things like company cars, medical insurance, life insurance, and other perks that the business can provide to you tax efficiently. So that's the most tax efficient way to pay yourself as a company director in 2024. If you found this video useful, give it a thumbs up and subscribe to my channel for more tax saving content.